Ladies and gentlemen, my name is Jesse Fergalli. You're listening to Working Capital, the Real Estate Podcast. My guest today is Kris Krohn. Kris is a real estate maverick, business coach, and eight-figure influencer, international speaker, breakthrough mentor, and best-selling author who helps people get on the path to wealth through real estate investing, business coaching, and mindset training. I can go through a laundry list of things that Kris has done, accomplished, but who better than him to run us through a couple of those things that we could talk about deals. Kris, how you doing today?
Jesse, great. Happy to be here on Working Capital. And what's up, everybody?
All right. So Kris, appreciate you coming on. I think for listeners that don't know who you are, a simple Google search or throw it into YouTube, they can see a lot of the work you've done. I came across your stuff a few years ago on YouTube. The content at that time, I was doing videos for the commercial real estate side with Bigger Pockets. And I really liked the stuff you put out because it was a little different than what I saw a lot in the real estate world was, you should do this, this, and that, but there were no practical step-by-step advice. And, you did examples, walkthroughs. So maybe for listeners that, like I said before we joined, that have been living under a rock, don't know your background, give us a little bit of, how you got into the wild west of real estate investing and the world of real estate in general.
Yeah, no, I appreciate it. So I, as a kid growing up, had mom and dad that would fight about money. I had 8 other brothers and sisters. And I'm like, wow, seems like money brings a lot of unhappiness. I wonder if I should be good at that. And so I made the decision when I got older that I was going to master the game of money. And I thought that meant being a doctor. And so went to college. Took my first Weeder class in chemistry. I got a C. My advisor said, you're not going to be a doctor. You got 10 years of this. You have to get an A. Retook the class. I got a C minus. And that's the day I realized I'm not going to be a doctor. Any other college class and every other degree just felt like a rat race, $50K to $100,000 a year. And it was like, that's the kind of money my parents made that they always fought over. That's not going to work for me. So it was actually a depressing time of my life because on the one hand, I was newly married and I had my best friend that I loved to pieces. And as a full-time student, I also worked full-time. And having 2 full-time jobs and still going into debt was driving her and me nuts. And we started fighting about money. I'm like, shoot, this is it. We're going to do this all over again. This is what it looks like. It's not her fault. It's my fault. It's just circumstance. And I just said, I need to find something different. And I had 3 mentors that showed up in my world. They had each made over $10 million in real estate. And I made a decision right then and there. I don't know what real estate really means, but I have caught the bug. And it's like, I'm going to learn this thing. Now, if you fast forward 4.5 years later, I graduated college. I had 25 properties. I only needed $3,300 to get all 25 properties. They paid me $12,500 a month residual income. And I was done with college. I quit my job. And because I was living on the cheap, like my expenses were $2,500 a month, I literally was pocketing $10,000 a month. And I'm like, this is the best thing ever. Next year, I doubled my portfolio to 50 and then to 100 and then now that was $2 billion ago in transactions and 6,500 doors later. And I haven't learned anything new in what I would teach you today for the last decade because I built a model so perfect. Works in up and down markets. Doesn't matter what the economy is doing. We vetted it hardcore in 2008. That's when I built my greatest wealth. I've been praying for a recession. And, the cleaning crew is finally showing up here in the United States. I think Biden has done a brilliant job at destroying everything. And we're printing trillions of dollars, devaluing the dollar, creating hyperinflation. Banks are failing left and right. Governments are doing the wrong thing, trying to bail everything out. And I'm like, wow, we have another perfect economy and real estate is like the greatest. So that's my little history on the game of real estate. I do love it. I'm highly opinionated. There's things I love in real estate and there's things I hate. And you will probably hate some of the things that I share with you if you're passionate about real estate because I have strong opinions. But I believe there is a best way and there's a right way and there's a wrong way. And that's my history.
I like it. Well, in all honesty, I think there's a lot of bullshit when it comes to people online talking about real estate, getting into it. And I think the part of it is the fact that it is bricks and mortar and people, assume, again, it's not rocket science, but people assume that, what they're learning online, anybody can do it. It's very, it is simple. And it's not a complicated thing to do, but like you said, there's a right and wrong way to do it. And anybody that tells you differently hasn't been, like you said, either has worked through a recession that we're typically going through. And I know we're not supposed to say the R word, but 08, 2001, the early 90s, late 80s, whether you've lived through them or you're a student of history, you gotta understand what happens in times like this. And if you're positioned properly, you can do well. And even on the commercial side of things, we see very large and very small investors that are doing capital calls, that maybe were over levered, and now, with interest rates where they're at in the States, like you said, some things are going crazy, and I want to talk a little bit about that. But take us back, when you're, I think, over 5,000 deals now that you've done, something to that order. When you first started out, what were you buying? Were you kind of building triplexes to quads to apartments, or was your strategy different? And maybe, for listeners, if you could kind of shed some light on that.
Yeah, so I was definitely never going to hack it as a doctor because I just couldn't get chemistry and biology. My brain isn't wired for that. But I thought at one point I might want to get an MBA. So I had to take stats as a weeder class, and same pontificating lecture on day one from the professor saying, ha, 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 you guys want to become, MBAs. No. My job is to fail 90% of you, grade you on a curve. And I was like, oh man, not this again. And I got them course material so well that I often didn't go to class. I never did my homework. And then when I took the final test, they graded the entire curve on me. I love numbers, stats, and probabilities. It's just something I'm really keen on. And I share that with you because when my first 3 mentors started teaching me real estate, they were arguing amongst themselves with the question I would ask: hey guys, which strategy is best? And they're like, I don't know, like wholesale is great, but then so is flipping. And then we like multifamily. They're all good. And I'm like, no. If I need to walk across town, there is a fastest way to get there, and I don't want the circuitous route. There's a best. And they said, well, that's not fair. I said, oh, it's fair. Mathematically, there's best. And they said, well, Kris, your answer has to include your bias. I said, what do you mean? They said, well, what do you define as best? And I had to get clear. And so I'm going to share with you my 6 criteria, because I am going to share a strong opinion on a strategy from 6,500 deals ago. And here's what I ultimately told myself. I want the strategy that will not take my time. So it has to be passive. It has to be easy instead of hard. It has to have low risk instead of high risk. It has to be the most profitable. It has to work in up and down markets. And lastly, it has to create value. So that there's a triple win. I got to win. The person I'm buying the home from has got to win. Whoever's going to be living in the home, there has to be a win. The community has to win. So based on those 6 criteria, I vetted 30 major strategies. I actually ended up writing a book about this that I'm giving everyone away for free. But what it told me is that if I were to buy, Jesse, single family homes bought below the median in the best markets for a short-term 3 to 7 year hold period of time, that I would maximize my ROI while requiring the least time, effort, and risk. I use that as my theory. And 4.5 years later, I had these 25 homes and it tasted so good. And in 2008, the world came crashing down, and $1 million house became $500,000, and $500,000 became 300,000, and a $300,000 house became 220. And meanwhile, I went into Vegas and Phoenix and the most hurt markets, Florida, and I started buying up $300,000 to $400,000 homes from the bank for $100,000 or $120,000. And I did thousands of them. And guess what happened 5 years later? Well, if you understand real estate, what I love about single family is that it adheres to supply and demand. And in a recession, just because people lose their jobs doesn't mean they stop having sex. People make babies, population increases, America's still great, people move here. And that means that eventually we are going to need more houses. So 5 years later, that house that I bought for $125,000 was now selling for $250,000 to $300,000. And I helped my investors make over $100 million. And I was like, oh my gosh, not only did I prove that my approach to real estate, for me, hands down, based on that 6 bias criteria, is the best, but I've also finally proven that the worse the recession, the worse the economy, the better it operates. So we are in for one, and it's years late, and I'm looking forward to it.
I like that. In terms of so for single family, and like you said, you ask 3 real estate individuals, a question on something, they'll give you 6 different opinions. And in terms of the actual strategy, how do you scale this single family game? For those that, don't know the background for what you do, in terms of How do you get it to a larger scale? I know we've seen Blackstone do it, but there's a little investor, there's you, and then there's
Yes.
these huge REITs and pension funds and real estate conglomerates that are doing it. So how do you scale the single family game?
Yeah. So you are correct that the only people that are figuring it out at scale are hedge funds and REITs. There's no guru person out there that so far has been dumb enough to tackle scaling single family, because here's what we normally do. Hey, I bought 10 homes and now I have more working capital and I'm going to graduate to multifamily. And you know what? I tried many times to graduate, Jesse, to multifamily. And every time I did, I compared my ROIs and I said, oh man, if I buy this $600,000 or $6 million complex, my ROI is lower than if I were to buy a bunch of single families. So I just basically said, I have to prioritize what is more important, convenience or ROI? And I made a decision. ROI trumps convenience. So I said no to multifamily. And it doesn't mean that I don't own any. It means, though, that the reason why I own so much single family and chose to figure out how to do the nasty game of scaling it is because I prioritize ROI, not strategy. And so today I have a team of 200 experts. And what I do is there's 324 major cities in America. And I economically evaluate each one of them. And currently I'm buying real estate in the top 5 markets. That would currently include Tennessee, Alabama, and Florida, to name 3 of them.
I was going to say, we still like Florida, right?
Yeah, 100%. So
Beautiful.
my average product today is a $235,000 house, usually relatively new or brand new, currently in this economy bought under market. When I rent it out, I get an average ROI. The last 3 years, I've averaged an ROI of 34%. Now, the reason why I keep saying this weird word ROI is because the other book that I'm giving you for free on a link that Jesse will give you here, what it does is it says, stop getting hung up on strategy and start getting hung up on ROI.
Mhm.
The reason why we're in a mess, and you guys are going to resonate with this, is because whether you look at investing in the stock market or your version of a 401k or IRA, what they all share in common is they're safe. And by safe, I mean the 30-year average is generally between 5 and 6% ROI. So on the one hand, we're saying, yay, I'm safe. I can't lose my money. But after 30 years of compounding, and you say, wait a second, the average 65-year-old using that methodology as a frugal human has saved $209,000 and yet is accustomed on average to living off of $94,000 a year. That's only 2 years of money. And that's the problem, is that safe killed you. Safe hurt you. Having valuing low risk destroyed you financially for your future, because in our day and age, modern medicine is keeping you alive for decades. So this is a problem. In real estate, you take that same $50,000 in a retirement plan, and at 6% over 20 years, it will triple to 160 grand. You put it in real estate at no less than a 25% ROI, and it grows 27 times bigger to 4.3 million. So I believe, Jesse, that the average human being is capable of buying an investment property. And then if they use the right system and grow it over 20 years, they can turn it into millions of dollars. And that doesn't make you wealthy. You know what? It's also not only $209,000, because you can give a couple $1 million to your financial planner, base it on the 4% rule, and basically have around a 6-figure retirement fund. It's not rich, but when you're older, I got news for you. You're going to want to visit grandchildren. You're going to want to travel. You're going to want to do fun stuff, and your age is going to cost you more money. And people just aren't prepared for it. I'm going to live to be 140 years old. I studied the futurists. I look at modern medicine, and I am the fittest I've ever been at 43 years old, because I got another 100 years to go. My choices determine my lifestyle, and I'm keeping myself as healthy as I possibly can because I'm planning on living a long time, but I'm also building assets accordingly. And so, my biggest advice just starts with focus on ROI instead of strategy, because I'm talking a lot of strategy,
Yep.
but first just ask, where will my money perform the best?
I got to insert a Talladega Nights clip when he's talking about living to 350 years old when you said 140 there. We do that in post. Okay. So I always, I've told investors before, and I've talked about the, the way that we make money in real estate, usually 4 ways. You have appreciation, cash flow, tax advantages. And one thing people usually forget about is the amortization of your mortgages. Now, you did a video a while back, and I think you were in your kitchen, you're on a board, and you were talking about ROI, and I'll try to dig it up and put a link to it, because I like how you kind of went through it, like you said, from the numbers angle, just cold logic of how we're figuring this out. Because in our industry, as you know, there are a million different metrics for valuation, and some are subject to, like the cap rate's the one that gets made fun of the most, because, you've got the seller's cap, you got the buyer's cap, you got the broker's cap, and, everything kind of moves around. I find the way you structure ROI and think of it is a little more to the point, and probably easier for people that are just getting in, as well as people that are kind of seasoned vets. So can you unpack ROI for us, the way you look at it and your team on basically values?
Yeah. So when I say that we hit a 30% ROI on a property, people are like, what does that mean? I say, well, first of all, it means that your money doubles like every 2 years. That's the first thing. And it's important for you to know that, because when your money is growing at the stock market's average rate of return, it doubles like every 12 years. And if you're going to have a 40-year working life and your money can only double 3 times, that's why we have a problem. But if your money can double every other year, every third year, well, then what I'm telling you is not going to make you rich in 5 years. I have other advice for that. But it does mean that in your lifetime, you can be. Most people are using a system where they will need multiple lifetimes, like 5, 6, or 7, like 300 years before they can become wealthy. And so it's because they're committed to that single digit ROI. We're going to play a different game here, and we're going to focus on that double digits. So that's really what real estate is doing. So let's talk about how you get to 30%. The first one is cash on cash ROI. That means if I put money out, I want to calculate, what do I get back in the bank? And let's just say that your cash on cash on an average deal is 5%. So that means that I put out money. Let's say it was $50,000. That was my 20% down payment. Then I'm getting $2,500 back every year in the form of positive cash flow net. So that's 5%. That's 5 of my 30. Next, let's just say that my appreciation, because I'm highly selective of growth markets that appreciate abnormally higher than the rest. And this is like a time machine talk. Like, I'm going back to LA before it boomed in the 70s. I'm going back to New York in the 40s. I'm selecting the markets where all of the economic stimulation is coming in, population is moving, and we have a supply and demand crunch. And those markets, based on that and a dozen other factors that I'll give you away on this link, are continuing to grow. So let's just say that I can calculate, my property, based on the research and data for that area, is going to appreciate by 7% a year. Remember, we're at a 5-to-1 leverage. And that means that I'm actually getting a 5x on that, a 35% ROI. Well, we're going to make the number small and just call it 20% of my ROI is appreciation. 5% cash on cash, 20% appreciation. Now I'm at 25%. Number 3, let's talk about that buy down. We are delegating a human being to pay off our mortgage, and there's an ROI on that when you go to sell it. And on average, on a single family home in this price range, it equates to about 5%. So now I get 5% I realize from cash on cash, 20% from appreciation, and an additional 5% from the tenants paying it down. That's 30%. Then I have the tax benefits, and I will never calculate that one because all of our tax brackets are different, but it's good. And you stack all 4 of those together, and now you have an ROI. I like to understand my ROI in each of those different facets, and collectively they have to be over 25%, or I ain't pulling the trigger on the deal.
Yeah, I think that's exactly the way to look at it, to actually unpack it and see the different kind of levers and basically the different income streams within the total income stream that you're getting over the term. Want to kind of shift gears a little bit to, you talked about how you're such a huge fan of Biden and his policies in the last little while.
Let's go, Brandon.
For the, as we, I've told you before, we have Canadian guests, we have US guests, a lot of stuff's going on down in your area right now. I'll keep this podcast and the video evergreen. So, in terms of what's happening in the economy with interest rates, with, like for investors that just started investing the last few years, this la land that we had of 1%, 2%, 3% interest rates
for a decade. Crazy.
Yeah. And it's wild to think about, I was talking to my buddy the other day, the first mortgage I ever got, I think it was at 6% fixed, and we're always about a point or two lower than you guys. So, that was, seemed normal. And then for a long time we were very, very low. And now, all of a sudden money costs money again. So what are your thoughts on what's going on right now? I know it's a big question, kind of the policies. And then more specifically for you, you talked about how one of these 6 items that you have is that up and down markets, you want to perform. And, what is it about the strategy that's performing in the 1 to 2 years here?
So if I can, Jesse, I want to start by giving everyone the cheat sheet, this book that I keep talking about. If you go to freewealthgift.com/capital, freewealthgift.com/capital, that will give you a book that really downloads everything on my perspective, my strategy, because there's a shortcut there for those of you that want to do a deeper dive. So to answer your question, what's happening in this crazy, crazy country? Recovering from the pandemic, printing trillions of dollars, and a bunch of Democrats that think that printing money is going to solve our problems. This is called financial easement. And what they're doing is they're inventing money, believing that they're never going to have to pay the piper. But when inflation now hits 7 and 8% and risks rising even more, there's a cost to that money because we are accelerating the depreciating value of our dollar. So they only have one lever to pull to fix it. If you want to print money, the only other lever they can pull, according to Ray Dalio, who's a great economist who returned $27 billion to his investors as a hedge fund manager, one of the most successful of all time. He said, the only option they have right now is to raise rates. And we habituated ourselves to a decade of basically free money. And so now we think 6, 7, and 8% is awful. It's actually normal. It's not bad. And it doesn't stop me from investing, but it's hurting a lot of people because what's happened with our supply and demand crunch is we never recovered in our lack of supply since 2008. Which means we're still missing in America around 4 million homes. And what that does is when you have a scarcity of something, it increases its value. And so the reason for 2 years during the pandemic, where we saw an average increase of 51% on real estate overall, is it was in response to that supply and demand and free money. When they raised the rates, what it did is it slowed down all those buying habits, because a raised rate all of a sudden meant that this mortgage is going to cost me $500 or $1,000 more than I was planning. And the government successfully stopped the economy. They did this because they have to stop inflation. Why? Because they just authorized printing another $1 trillion. Someone just isn't getting it because they think that we can afford things that we can't. A government is actually a business. And there's a really great rule for not running your business into the ground. Only spend money you have. If you're going to borrow it, you better be able to pay it back. And these guys can't. So hence we have a problem. Now we're moving full-fledged into a recession. They've changed the definition so that no one can acknowledge it. We've lost 130,000 tech jobs this year. AI is doing what the Economic Forum said it would do between 2020 and 2025. They said we would replace 80 million jobs. We're halfway through that transition. It's in great acceleration right now. So we got a mess on our hands. But I have to tell you, this is not a problem. This is actually a really good thing, because the bigger the problem, the bigger the solution. You're only going to get screwed if you don't adapt. You're only going to get screwed if you don't change. Those that are on the fly saying it's time to innovate, constant and never-ending improvement, those are the people that are going to win. Now is not the time to dig in and work hard on what you've been doing. It's time to actually ask, are you in the right business? Evaluate the new landscape and ask, am I doing the right things? Because if you look at what I'm doing today, yes, I'm continuing to build a real estate empire, and the interest rates aren't slowing me down, nothing. In fact, I already know this is the time to double down, triple down, quadruple down, and buy more, because my biggest regret of 08 was that I didn't act more. 100 million in profits was awesome, but why not $1 billion? I should have 10x'd. Well, I'm not going to make that mistake again. But as to what I'm doing today, I've also in the last 5 years got my hands, Jesse, on very different information. You see, 90% of millionaires do it in real estate. And they're usually accidental millionaires. It was over my 40 years, I accumulated a few homes and I got my house paid off. And look at all that. The equity is greater than my retirement accounts. And when you add it all up together, I'm technically a millionaire. You're still screwed. There's no cash flow that comes off of any of that. Yeah. But I say, if that's true, why not actually do it intentionally and do a lot more? 5 years ago, I got my hands on the real information. If 90% of all millionaires do it in real estate, 100% of all billionaires do it in private equity. So what am I doing these days? My real estate machine is a machine that is fixed and set. People find me on social media, become my partners every day. We go out and dominate the world. We produce these ROIs, but now I build companies that produce triple-digit ROIs and quadruple-digit ROIs. And that's also in the free book that I'm giving everyone here, is a system that if you diversify ROI from single and include double digits in real estate, triple and quadruple digits in business, you average that out. And now it's not trying to see if you have enough money for retirement in 4 years. Now I became financially free in less than 5 years. And it's just a function of selecting vehicles based on ROI, not was there little to no risk. Instead, there's a way for you to take risks, not put all your eggs in one basket, and win hand over fist left and right while still losing. And that's really what I teach. Is it's a different probability game. It's that math of statistics that I love so much.
Yeah. So there's a lot there. I want to unpack a couple of those things. So first of all, there's a great book, The Motivation Myth by Jeff Hayden. I mentioned on Instagram. And he brought up the top 400 earners, the IRS earners, and anybody can look this up. It's the most, pure IRS. The most recent data is 2008, but it really doesn't matter because it's a talk about what you just said here, the distribution of, and it's not surprising most people that have looked into this: salaried employees, entrepreneurship, real estate, capital gains. Where is 90% of the wealth coming from? Capital gains in real estate. In terms of, I love a Milton Friedman kind of concept when it comes to inflation that you were talking about. And it was very simple. And that's, I think, what he was brilliant about. If anybody does not know Milton Friedman, if you're interested in kind of understanding a little bit more on the free market side of economics, you talk about inflation, that it's a lot like alcohol. It's like the first feelings come on first, good feelings come on first, they feel good. And it's only later that the pain happens. And it's a lot like the cure. The good feelings don't come on first. It's the bad feelings that come on first and the good ones follow. And to correct ourselves out of this, or to, like we said, if rates go up, yeah, there's going to be the intermediary pain, which we should have had probably years ago. It would have been less intense. And it seems like in the States right now, we're kind of doubling down on that with the bank bailouts and not letting, whether you debate whether you let them fail or not let them fail. The moral hazard of constantly being able to tell people it's okay, low rates, don't worry about the consequences of the money you spend and what you do. So I think you're right. I think if anybody's interested or was weary of getting into real estate in the last 3, 4, 5 years, now is the time. It really is the 08s, the 01s. Now is when people actually, like you said, can find deals and be able to actually build wealth. The last thing I'll say is just your piece on the fact that, you could have $1 million in net or in asset value or net wealth, but you don't have access don't have access to it. And there is something to be said about that. And I do think with real estate, and especially in Canada, because we don't have 1031 exchanges. So we are either selling or we're not selling, right? Refinancing now is becoming something that comes at a cost. So maybe I want to be mindful of the time here, Kris, but for people out there that are getting into real estate, maybe they had gotten in the last couple of years or kind of thinking when the right time is. I hear all the time from people that email me from the show, is now the right time? I've got that email for the last 5 years.
Yes.
What are your thoughts? How do you view that for individuals?
First of all, I selected a strategy that is so recession proof that when the market goes up, I'm happy. When the market goes down, I'm happier. And so the timing is right with the right strategy. And right now, I have been buying the last 5 years as much as I possibly can. The next 5 years, I will keep doing the exact same thing. And the reality is I have a system that works so well because humans make babies and people need houses that I'm not going to stop. And it's a system that just works all the time. Now, I'll tell you, there's ROIs that are higher than what I get in real estate, but they're not sustainable. They're not duplicatable. I selected a system that says I need it to be a sustainable machine that doesn't take new ideas or new thought or new effort. I need it to just do its thing no matter what and compound. 25% on real estate in 5 years when I double my portfolio is now 50%, and 50 becomes 100%. 20 years from now, you're earning hundreds of percent a year on your original dollars in. And that is a great long-term wealth strategy. And so I guess my advice is, yes, now is a great time. And especially because we're heading into a recession, it's an even better time. Because I got news. 2 years ago, I needed to buy all of my real estate cash. Guess what? Cash offers don't matter in this economy. I can put terms out there all day long and win deals. And that's because the market is ripe for this disruption. But I'll also share, I don't think we're going to experience a crash here in the States. What I'll tell you is we're experiencing a correction. Even Zillow came out and said that they're expecting a 0.1% correction this year. And what that basically means is the market is going to hold steady as we catch up. Now, over the last 65 years, Jesse, I tracked that the average appreciation nationwide is 4.65%. So in 2 years, when you do 51%, you do the math on that and say, wait, 4.65 times 2 years, that should have been around 9%, but we did 51. That means that 42% of that over time needs to correct. And so I'm buying, when I say in my system, I buy below the median, I'm buying below the median that should be. The current median in the States is 409,000. It's supposed to be 290,000, which means that when I buy at 230,000, I'm still buying my typical rule of 20 to 30% below what the median should be. So there's a lot of math behind this. That's why I'm giving everyone here away my book. I think that it'll help you. And I have one final thought, Jesse, that I think is really valuable. We are lone wolves by nature. We want to do everything ourselves. And when you're building wealth, you are the last person you should take advice from, because you only know how to create more of what you've gotten. And if you're trying to do something new, don't think that a podcast or a book is going to change things for you. My world today, my wealth is expanding greater today than ever before. And we're talking about multiple 9 figures a year right now. I've had a 13-year goal of becoming a billionaire. I can almost throw a stone at it right now. And when I look at where the majority of that wealth came from, it came from this. Find smart, intelligent people that are experts in their field. Give them half of the gains to do all of the work. I do that in my businesses, in my tech businesses. I do that in my franchises. I do that all day long. That is where my greatest wealth comes from. But it defies this idea of go it alone, do it alone, and get 100% of the rewards. But I'm telling you, 100% of a grape is very different than 50% of a slice of watermelon. And for me, I actually like watermelon. I like grapes, but not as much as watermelon. So I think my final advice is that in this economy, go find experts that already have 10 times more than your wildest dreams would ever allow, and see if you can find a way to do things with them or steal and use their systems. Don't be a lone wolf and don't reinvent the wheel. All these strategies are known. The shortcut to the top of the mountain is working with the people that have them.
I like it. So Kris, in terms of where we can send individuals who want to get in contact, we'll put the links in the show notes here. Aside from a Google search, and we didn't even talk about YouTube. I'm sure we could do another half an hour, 40 minutes, maybe in a few months to kind of talk about that world of your business. But yeah, where would you send people? And throw in what's on the Kris bookshelf or podcast shelf these days?
Yeah, so my most recent book, Have It All, is the book that I'm going to give everyone away for free at freewealthgift.com/capital. I think that's a great place to start. But I'd also hit me up on either my Kris Krohn Show podcast. It's called Have It All, or you could also go just check me out on YouTube. And if you've enjoyed this, then I do about 2,000 posts a week. Believe it or not, it's a system. I've got a great team of people that make that happen. I'm inundating the world with as much financial knowledge as possible to empower those that want to be empowered. And of course, you can also just Google me. But just understand that in my world, my way of helping people is I don't believe in giving you a fish. I don't believe in training. I don't believe in courses. What I do is I say, if you found the right person, partner with them on their track record of $2 billion and do it together. And that's how you're going to win. I win because I give you fish. And 30 years ago, everyone wanted to know how to fish because that great saying. But today, you know what we really want and what I want? Every time I start a new business, I find the smartest, most brilliant winner in that space, and I make them my partner. And that's my greatest hack to winning. Don't go it alone.
My guest today has been Kris Krohn. Kris, thanks for being part of Working Capital.